here we are again.
Oh, right or right.
Same place, same time.
More or less.
Same bat channel.
Middle of October. Getting cooler out there.
Yeah, it was a little nippy last few days here. I'm just happy we're not getting rained on, poured on. I mean, by the time you guys watch this, the hurricane thing probably would have settled down a lot by then, but, recording on a Friday.
It's been a rough few weeks in Florida for sure.
Yeah. What you got for us, man?
We got a lot of stuff this week. I mean, the market's been, it's pretty much fixated on inflation or disinflation. And I think if you watch the mainstream media, it's all about the inflation rate, right? And that's fine when people talk about the inflation rate. But what we care about is actual inflation, right? How much did something cost last year versus what it costs this year? And if the inflation rate drops to the Fed's target of 2%, what that means is if it stays the same, if it stays at 2%, next year, year over year, the things that you bought this year are 2% more expensive than they are now. They never go down. Price. Yeah. I won't say never because I got a chart about that. It's not that they never go down, but you have to understand what's actually the difference between the reality between the inflation rate and what inflation actually is.
Yeah, I mean we need consistent inflation to keep other things in check. You need a level of what we don't want is 6%, 5%.
So what it really, we'll talk about this throughout, but at the end of the day, and one of the big takeaways, the big theme is, if you own assets and the inflation rate is 2%, your assets go up. I mean, not across the board, not everything, right? But your assets go up 2%. If you owned a home since COVID, you're sitting on a significant increase in the value of that house.
Right.
If you owned cash, your cash is worth way less. You're buying way fewer things with the cash that you had. So we'll kind of get into it.
It just depends on the asset. But generally speaking, though, I thought this is where you're going to go with that. Let's say inflation is 2%, and you're making 5% return on whatever investment you're doing. Yeah. You're really getting 3%.
Yes, in that case, you're beating inflation.
You need to be able to beat inflation. That's usually something people kind of, fly by and they go, hey, let's adjust that for inflation. Right. You still may be doing fine, but you have to keep that in mind. And that's why you want a reasonable amount of inflation to keep all the other things in balance, but you don't want it too high because that means you would have to get significantly higher returns on whatever investment we're talking about, whether it's your home or stocks, whatever. You'd have to have a significant return to beat that. Right. So it all matters.
Yeah, it does. We'll talk about it some more. I got some pretty interesting charts here, I think. So we'll take a quick look at what happened this week, and then this idea of reported inflation versus reality. And then 2025 is interesting. There's so much fear and angst about what's going to happen in 2025. It's ridiculous. But historically, what happens in years that end in 5 is kind of fascinating relative to where we are right now. And then the TSP fund charts, which are going to be different than they have been in the past. Okay, so Monday wasn't a whole lot. The most interesting thing actually was used car prices were down month over month and year over year. So that's deflationary, right? When prices actually go down, that's deflation. So there's inflation, prices go up. Disinflation, prices are not going up as fast as they were before, okay? And then deflation.
So it's still inflation.
Still inflation.
Right.
Prices still going up, just not as fast as it was before. That's disinflation. Deflation is when prices actually go down, okay? It's used car prices have come down both month over month and year over year. So if you were looking for a car last month, you're going to pay less for it this month. That's deflation, and that's one of the factors that goes into this whole Fed, algorithms. Tuesday, nothing really super significant, but the S&P was up almost 1%. Wednesday, we get 30-year mortgage rate moved back. It's heading back up, right? Long-term rates are going up, even though the Fed is cutting the short-term rate. So mortgage rates go up from 6.14% to 6.36%, which is a pretty big percentage move up. And of course, because of that, mortgage applications fall to negative 5.1. They were at negative 1.3. So housing is still unbelievably unaffordable, and the direction of rates, especially the long-term rate, is very up in the air right now. But again, the S&P is up 0.7% on Wednesday. The big one for this week was the consumer price index. Month over month, it comes in at 0.3%. It's up 0.3%. So that's an inflation index. It's up 0.3%. It was the same as last month, but analysts were expecting it to be 0.2% up. So it was higher than analysts expected, which means inflation is sort of sticky, right? It's not coming down as fast as they expected it to come down. Year over year, it was 2.4 versus an expected 2.3, so month over month it's up 0.3, but year over year it came in at 2.4% as the inflation rate versus the expected 2.3. So it's not going down as fast as they thought. Jobless claims rose 258,000 new jobless claims versus an expected 227,000, but which is not great. But the 4-week average also rose to 231,000 versus the expected 225,000. And then the S&P is down like 0.2% on the day. So some of these are inflationary, some of these are deflationary, which is why there's constant churning. And then Friday, the producer price index, which is the other side of inflation, right? It's the inflation that companies feel when they're trying to produce products. The headline number came in at up 0.2%, which is what analysts expected. But the core number, if you take out energy and some other things, it was higher than what analysts expected. So core inflation isn't really coming down as fast, and consumer inflation isn't really coming down as fast as the expectation. But the S&P is up. As of when we're doing the show, it's up. Last time I looked at it, 0.64%. So there's nothing telling you here that the Fed is done doing its job, that it put a put a stake in the heart of the inflation dragon, let's call it. We're not seeing that yet. This is a chart of CPI. So when inflation is coming down, that's good, right? So the Fed's seeing this and seeing inflation coming down. So now it can think about lowering rates, right? Because it's won the inflation battle. But for the past several months, inflation's ticking back up, and for the past couple of months, it's remaining high, right? So if the Fed is cutting rates in an environment where inflation is high, inflation just keeps moving higher because the Fed lowering rates is inflationary itself. So that's the trick bag kind of that they're in. All right, so reported inflation versus reality, right? This is a chart of the rate of inflation. Okay, so this chart goes back to 1915. So the zero line is if there's no inflation, right? If you're below zero, you have deflation. Prices are actually going down. The rate of inflation is negative, so what you paid for something today is less than what it cost yesterday, right? But you can see from the chart, there are very few. I mean, this is the Great Depression. Well, this is the Great Depression. This is the collapse in the early 1920s that nobody ever talks about, but that was on par of the Great Depression. This was actually the Great Depression, right? This is World War I. I mean, it's been a long time since we have had deflationary, real deflation where across the board prices are coming down. And it's generally associated with times that are not good in the economy, right? Even up here in 25. I mean, this is 2008, right? So in recent history, I think that's 2008. There are very few times in recent history where we've had prices actually go down. And the Fed doesn't want that. They need some sort of inflation to keep everything moving. But the So this is a chart of the rate of inflation, okay, and it oscillates around 0. When it's above 0, right? If prices have moved up, say in 1975, 12%, right? If the rate of inflation is 12%, and you never have any deflationary periods, the increase was less, right? This is disinflation as we're coming down here, but then the rate of inflation goes up again. So if you were paying $1 for something here, you're still paying over $1 for it here because it's the inflation is decreasing, but you still have inflation, right? Then inflation goes up again, so it just compounds to the upside of the debt. So another way of looking at that, if we kind of bring it into reality, this is a site called Trueflation. It's a really good site to take a look at. So this is going back to 2020. Okay, this is 2020 here. So since 2020, since January 2020, the cost of things is 26% higher than it was in 2020. Right? So we're going to October of this year, and we started at January 2020. So the true inflation, not the inflation rate, the true inflation since 2020 is 26%. So if you're retired and you had $1 million in your TSP, in 2020 you could buy $1 million worth of stuff. Today you can buy $750,000 worth of stuff. So if you had if you have all your money in cash, that's a problem because your cash can only buy, less 26% less than what you could. So if you're retired on a fixed income, you either shrink your requirements by 26%, or you get another job, or you do what you do. You have to have assets that can keep up with inflation. And don't worry, we're going to get to, that's why you should never be in the G fund, because the G fund doesn't keep up with inflation. We're going to get to that part too. So what would you do? What could you do to actually keep up with the rate of inflation? So the yellow line is the S&P 500, okay? And the blue line is still it's the same aggregate inflation rate. So if your investments are above the blue line, you are exceeding the rate of inflation. So in reality, if the S&P is up here at 15% and inflation is here at 10%, your real rate of return is only 5%. You're really only making, in terms of buying power, you're making 5%. Right.
That's what I was going back, talking about earlier when we were, people will, I won't say brag, but they'll be like, I got such large returns this year. And you're like, okay, well, where are we at with inflation?
Right. It definitely matters. And so if you kind of go forward here to, we had the top in January 2022, and we had been outpacing inflation since, COVID. But at this point, now if you're in the S&P, you're not beating inflation. So you could just use this chart and say, oh, okay, when the S&P is below that blue line, I don't want to be in the S&P anymore. Now, if you went to the G fund there, the argument would be, yeah, but the G fund doesn't beat inflation either. Yes, but it doesn't go down. Right? If you're in the G fund here, you're at least not taking the relative loss to inflation. So then when you get back into the stock funds and you start following this line back up, you're getting back above the inflation line faster. Okay. If you were buy and hold, you would look at this chart and say, yeah, but S&P is above inflation now, so I'm good. Yeah, you're back above inflation, so you're good. But you did not make up for this. Right? You can't ever get that back in terms of buying power. So what else could you do besides the S&P 500? And we can't do it obviously in TSP, but Bitcoin is a great example, right? Huge move above the level of inflation. And then even with this Bitcoin crash, it took us back down. I mean, on a percentage basis, you lost a ton of money in Bitcoin on that crash. But it still stayed above the rate of inflation. So, again, Bitcoin, if you get down here below the rate of inflation, you don't want to take this hit. So, but and it's more or less it's not back to being above it, but if you trade Bitcoin, you can definitely stay above that level of inflation.
Yeah, but I mean, let's talk about some of your options in the mutual fund window, right? And so
Sure.
if you, again, and this is all about education. So you get to the point where you're an educated investor, very, capable and confident.
Yep.
That's when the mutual fund window can really be your friend, right? Yeah. So S&P isn't performing as well, or any of the funds, right? It doesn't matter whether it's a C fund or S fund or I fund. They're just not performing well enough. They're definitely underperforming inflation. All those things are in there. Okay, well, then you could take advantage of some things in the mutual fund window to at least get you potentially closer to that level. It goes back to what you were saying about the G fund, right? So there's being in the G fund, so I'm not losing money.
Yep.
Now I take a chunk and I go to the mutual fund window and find something that is performing, right?
Yep.
And so would that get me back above inflation in those scenarios? Yep. Probably not, but it's going to get me way closer so that when it does roll back up and start going up again, it's faster, like you said. So there are definitely different ways to play the game, but you have to be in a position to do it. You absolutely can't be a buy and hold investor. Right. None of this matters to you if you buy and hold, because true buy and hold is I'm in it and I'm not paying attention. It's just where it's at, right? So not a kind of buy and hold, which is where a lot of people are, and they say they're buy and hold. They're buy and hold for a time, and then I'm going to buy and hold this, and then I'm going to buy and hold that.
Right, and that honestly is everybody. It's a meme, right? People sell at the top or buy at the top and sell at the bottom.
Yeah. Unfortunately, that happens way more than people are willing to admit.
Yeah. Oh, absolutely. I mean that's the 50% level, 50% retracement level is not a Fibonacci number, but it's on every Fibonacci scale
real.
because it's what people do. Yeah. When you lose half your money, you're like, forget it, I'm out.
Yep.
All right, so Bitcoin, that's what it would look like. Gold. Is gold a hedge against inflation? Gold has had a big run. And
you would get people to argue this until they were blue in the face.
Yeah.
And it's right there. It's the data. It's what it is.
At least, since COVID, there's so many different ways to look at gold. I had a conversation the other night, and
I was trying not to bring that up.
Yeah. No, I mean, there's just so many ways of playing the game, and it really comes down. Most of the time, it's because people believe a thing, and they don't actually look at the chart of it.
Yeah, I can't tell you how many times. I mean, I listened to that conversation, and I was like, I've already had it with them because I'm just like, you're not listening, and because you're trying to convince yourself you made the right decision.
Sure, and
I don't want to accept that I might have made a wrong decision, right. And so I'm going to dig in my heels, and gold is the way to go. And okay, it's your money.
Yeah, it's your money. I mean,
it's your money. Do whatever you want to do.
Yeah.
But that little chart right there would make you not want to have. I mean, if that's what you were trying to do, which is a lot of people make that argument, right? Yeah. Gold is a hedge against inflation. Well, that chart tells you otherwise, and that chart's just the data. There's no fuzzy math in there.
Yeah. I don't even want to go down the road. There's so many things about gold, particularly that reasons people buy it, and at the end of the day, who knows? The BRICS, the next big BRICS meeting, Brazil, Russia, India, China, whatever.
Yeah.
Now there's 50 countries that are in the thing. That's October 22nd, and apparently, I don't know if they're going to announce it at this meeting, but it's coming that there's going to be an alternative to the dollar, and apparently it's going to be backed by a combination of gold and all the currencies from the countries that are within BRICS.
Mm-hmm.
And the price of gold, I was listening to a video last night, and they were talking about, right now, everything is based on the dollar, right? It's that the dollar is a world reserve currency. If a group of countries get together to competing against the dollar, meaning countries can trade with each other without using the dollar, so they're using some other. So if gold is what at least partially backs that currency, then and they're creating a new currency, why couldn't they just say, okay, the price of gold isn't $2,600 an ounce. In our currency, gold is either $3,000 an ounce or $300 an ounce. Like whichever way they went. Would there be a rebalancing in the price of gold in the rest of the world? Like, there's so much going on right now.
Yeah, because it's valued right now to the dollar.
Right.
So if you're saying we're not going to use the dollar as the value, then you could just make up a value of gold.
That's what they did in 2013 or whatever, 1913. Yeah.
Yeah. So, But a lot of people kind of let that stuff just slip right by past them. And like, okay, that's an important point. Like, because right now the dollar is driving all these price points. And so if it's $5 for something and all of a sudden you say, well, we're not using the dollar, so $5 doesn't mean anything.
Yeah.
Okay, well then it's 70 of this thing.
Yeah, Cougarans or whatever.
Exactly.
Yeah. No, there's so much flying around in the world right now. If you are not, it's not even a matter of paying attention because you can't possibly understand it all and know it all. Even if you could just take in all the different, the top 5% of all the different things, it's mind-boggling, but it all matters, Median sales price of a house. If you want to be buy and hold something, buy and hold a house, right? You never got really too far below the rate of inflation. You're pretty much tracking with it.
Yeah, for years I was a big. I wouldn't say I was against buying a house, but in our profession, we moved around so much that it was just a struggle to why? Like I wasn't being there, and then I get stuck here. And regretted it or whatever.
Me too.
But buying a house right before COVID was actually probably one of the best investments we ever made, just because this happens to be a time in which that paid off really well.
So ironically, the chart doesn't go back that far, but if you were back here, when the price of houses are falling, you're still above the inflation rate, right? So there's a lot of ways you can look at this. You can say, I don't mind if my portfolio is going down as long as it continues to stay above the rate of inflation. That's probably a really good kind of way to keep you from over trading.
Well, it's one of the metrics you should have in your, because, people talk about performance all the time. And they always want to make about it the simple rate of return.
Yeah.
And there's risk-adjusted rate of return. Yeah. There's am I beating inflation? There's all these things, and you need to look at all of them and figure out which ones are important to you.
Yeah.
And that needs to be your metrics. Say, okay, I had a good year.
Yeah. Yeah, for sure.
Or I didn't have as bad a year as I thought I did. Because, yes, my investment, my overall portfolio went down, but I'm still beating inflation.
Right. At the end of the day, as a retiree, that's or somebody who's building into a retirement account. Huge. That's what you need.
Yeah, you want your money to be worth as much or more, not less.
I mean, when you think about it, we're just talking about TSP, not the pension, because unless all things really go bad, the pension's going to be there. But if you are withdrawing $1,000 a month from TSP to make ends meet, if inflation is 26% over 5 years or whatever, now you have to take out $1,250 a month, right? And that obviously decreases your principal. So if your principal of your TSP account isn't rising to meet the withdrawals that you're making, if your withdrawals get higher and your principal stays the same or goes, God forbid, goes lower, you got a big problem. So housing is a pretty good one. Okay, so 2025, completely shifting gears. I think this is fascinating. So I asked ChatGPT, has there ever been a down year in a year ending in 5 for the U.S. stock market? Because I've seen a bunch of different videos on this, and it just is fascinating. There's so much going on right now that you think 25 is going to be the year, at least the beginning of hellfire and brimstone. Historically, years ending in 5 have generally been strong years for the market, particularly in the context of the U.S. stock market. The trend is often discussed in the realm of market cycles and patterns, but it's important to note that these patterns are not based on any concrete market fundamentals. Okay, so we're not talking about all the concerns and the worries and earnings and interest rates and all that. We're not talking about any of that stuff. However, from 1905 through 2025, okay, all years ending in 5 have historically been positive for the Dow Jones Industrial Average or the S&P 500. 1905, up 38%. 1915, 81.7%. 1925, 30%. And these are all time frames when we think that everything's crashing and the market's horrible, and it was. 1935, 38.5%, 45, 26%. It just keeps going, right? So although some years like 2005 and 2015 saw relatively minor gains, right? So we only had 3% and 1.4% in 2005 and 2015. Those are by far the lowest positive gains on a year ending in 5. U.S. stock indices in years ending in 5 during the 20th and early 21st centuries have been up every year. So keep in mind, the past performance is not indicative of future results, yada, yada. But for the past the past 15 cycles of that, this will be the 15th this year or next year, the market has always been up and up a lot. So if you look at that, what does that look like on a chart? We've kind of done this before. This is a chart, historical chart, going back to 1897 to 2020 of the year of this is a chart of the year in which it ends. So this could be 1900, 1910, 1920, right? It ends in 0. The years ending in 5 are by far the biggest move in the decade. By far. Now, it's the average, right? It is amazing when you look at all the things going on in the world that we could get something like this in 2025. I know there are people that buy into this whole thing that the world is coming to an end. And if history repeats itself, they're going to be sitting in the G fund, let's say, or worse, shorting the stock market. In an environment, in a historical perspective where it has always gone up. So how you hold those two things in your mind, I don't know, but at least now you know. You're like educated, right? Okay. TSP chart fund. So Conan did a bunch of work on this. We have now in stock charts, not TradingView, all the data for all the TSP funds. So we can I prefer TradingView, my preferred platform. We can't get the actual numbers of the TSP funds in TradingView, but we can in stock charts. So these are, if you go to the TSP website, as of Thursday's close this week, it was 91.0785 or something like that, and it rounds up to 100th. So if you go back and look at it, that's the number that's in the actual TSP site.
Right. That's the real price.
The real price.
Real price meaning, again, we kind of had this discussion. I think it was on our Facebook Live. It wasn't on the show. But we were talking about the price of there are no shares of the TSP.
Right.
There are units of the TSP, right? And so people get really confused with this, but there is no share price in the TSP. There is a price that they associate with a unit of measure of the, they don't, because you're not buying anything.
Right.
You're not buying a share of a company or an asset. And so, but to make this work, you have to have a price point. And so that, you will never find that on any ETF. You'll never find that anywhere. So the only way you'll find that is to go look at the actual fund, and that's the actual price. And so for years now, for decades, we've been using these ETFs because that's the best thing you could do to track on the charts. Yep. And the problem with that is you're not getting the exact movement because there's going to be discrepancies because, let's back this. I think this is the best example for me anyway. So the C fund is trying to match the performance of SPX.
Yep, the S&P 500 index.
Right? You can't buy the SPX. Right. It's an index SPX. Now, they have a ticker symbol so we can see it. What you can buy is SPY. Right? And that is, again, a fund that's trying to track the SPX.
Yep. SPY is trying to do the exact same thing as the C fund.
Exactly. So to use the SPY to make decisions about the C fund is the best you can do.
Yep.
except when you can take the actual closing prices from the C fund and put them in a chart. Now, if you go to stock charts and you start looking for these, they don't exist for you because we created these. And I'm not going to tell you how to do that on the show because it would take me 2 hours.
And you have to have a pretty high level of
yeah, it's not
account
impossible. If you're even mildly geeky, you could figure it out. You know, I'm not trying to pretend like I'm some wizard and did this. It's just that honestly, we didn't know that stock charts gave you the capability.
And along with that capability is a cost. That's what I'm saying.
Like we
can't do it on the free side.
No,
we
have to pay a pretty good penny. It's not massive, but you know, this is our job, so we pay for it. So my point here is, though, it's possible for other people to do this. You got to be a little savvy, you know, with your technology, and you got to be able to, you got to pay for it, you know. And so I wouldn't do it if I was the average person. I would just watch the show.
I watch the
show and then use the SPY. And so I wanted to make sure to point that out, that people aren't freaking out and going, well, how do I get access to that? I don't think it's worth it for the average person because you got us to do it for you, and you just watch this and see it. Because you shouldn't be. We talked about this before the show. You know, we say this out loud a lot, but I don't think it sinks in for people that you really should not be looking this, you know, throughout the day, maybe even not daily. You kind of have to make your decision on a day, as Jerry always points out. So that means you'd have to look at it daily. But in general, what that really should look like is you look at it weekly. And you know that a decision point is coming up, so I start to look at it a little closer for a while, and then one of the days I pick to make the allocation change, and then that's going to hold. That's going to hold for a while. It shouldn't be tomorrow it changes that much. It won't. So the point here is, you know, because this chart you're going to be looking at, these are only closing prices. There's no candlesticks. There's no intraday. Why? Because the TSP fund, just like a mutual fund, only has a opening. It only has a closing. You know, and the next day.
So on this chart particular, they are candlesticks because it's a weekly chart.
Right. Oh, that's good to point out.
Yeah.
Yeah. Once you get past daily there's intra-week because we have daily prices.
Right.
So this is intra-week. It's not intra-day. But it's very useful because you're actually looking at the real C fund here.
Yep.
And you know exactly, because there's been times where, you know, we knew it, but we couldn't do anything about it. Like, you know, the C fund itself wouldn't necessarily reflect the movement that we saw in SPY. Right. Like 100%.
Nope.
It's probably 85%.
Close. It's always very close.
Yeah, it's very, very good solution. But it wasn't exact. Nope. And that's very annoying to an analyst to go, no, well, I want to look at the exact thing.
We would see it in Facebook too. Why is there a discrepancy between, you know, the VXF and what the S fund actually did or something like that?
Because it's not the S fund.
It's not the S fund.
Yeah, and the VXF is not DWCPF.
Right.
It's not the same. They're both trying to accomplish the same thing, but they're not the same. Right. And so, all right, you got a little bit of a lesson on this. It's probably a little more than we needed, but you need to understand why the charts look like this.
And I'm sure we'll get people asking, why we went from TradingView to. It's not that we are going. We're just going to present the data this way because it's the actual TSP numbers.
Yeah.
And nothing really is different.
And it's a weekly chart, which is what we do anyway.
Right.
On the show. Now, if you're a subscriber to the site, we go daily, and we look at things a lot more in depth because, again, you have to make a decision on a day. But for all sense and purposes, this is fine.
Yeah, absolutely. So, and it's the same thing. If you were watching the last couple of shows when we talk about the weekly chart, this is still the 20-week moving average line. Each candlestick is 1 week of price movement, and you got the relative strength indicator down here, right? So we talk about divergence between price and RSI all the time. So as price is moving higher into the top in 2021, relative strength is declining, right? And so we talked about this before, we still kind of see that, right? You got price coming up and relative strength still declining. It looks like it's going to break through there. So it looks like it's going to resolve to the upside, which would be great because it means price keeps going higher. And that's what we want to see. But this was a big red flag for the top in 2021. And this is a big red flag for right now. But it doesn't mean it has to resolve to the downside. It can resolve to the upside. But the chart looks, for our purposes, it looks the same as the TradingView chart. So we're good. But it just has the actual numbers, which is great. S fund, same kind of thing. As long as we're on a weekly basis above that 20-week moving average line and the moving average line is moving higher, you're good. The trend is up. You can talk about all kinds of what ifs and things, but as long as the trend is up, you're in good shape. It's a retirement fund. As long as the trend is up, you're in good shape. One other thing on the C fund, I just wanted to point out, the 20-week moving average line is important, but that 50 line on relative strength, as long as relative strength is above that 50 line, right, price is moving higher. It's gonna oscillate, right? And you use the 20-week to kind of get an idea, but even here, we got below the 20-week, right? But RSI never got below 50. So it's, yes, price came down, but the momentum behind that price movement to the downside wasn't that bad. Once we got below 50 on RSI and below that 20-week line, that's when you have problems. When price stays below that 50 line, that's when you have problems, right? So as long as you're above that 50 line, you're good. And every once in a while, you're going to get this. And that sucks, right? It's called a whipsaw. But that's the way it goes. Okay. S fund. I fund. Same kind of thing almost as the C fund from 2021. I mean, as long as price stays above that 50 line in RSI and we're above that 20-week moving average line, I fund is doing good, right? It looks great. F fund is going to be the focus of this weekend's newsletter. So if you're a subscriber, you definitely want to check that out. F fund, this collapse, it's fascinating because as the Fed is cutting rates on the short end, right? Because the Fed only controls the short end of the curve. The longer end of which is actually the bond market, is not buying into what the Fed's doing. Rates are going higher. Mortgage rates are going higher. The TLT is breaking down. The F fund's breaking down. So the bond market and the Fed are kind of coming to loggerheads, and the volatility is just gonna get worse. Which doesn't mean price keeps going down. It's gonna go up and down. But I would stick with, if you're in the F fund, that 20-week moving average line and that 50 RSI line, just like the others, it's the same. All right. Oh yeah, I forgot. Now we have the G fund.
That's right.
Because we can do, so the G fund, even though this says weekly, from reading the TSP website, they changed the value of the G fund monthly, right? So
yeah, it stays pretty consistent.
It's pretty consistent.
So you even though you're putting in the daily numbers, they don't change.
Right.
So it really changes for sure once a month. We'll know because we're tracking it now this way. We never had a way to track the G fund other than just it is what it is.
Right.
I mean, whatever the rate.
There is no chart of it. Yeah. Until you just made this chart.
Yeah. I mean, so what I did was just take the daily closing price from the G fund, and Stock Charts allows me to make a chart out of that. And I just found it interesting because I've never really seen a chart, and to see that sort of flattening out.
Yep.
And then the rise again.
Yep.
Just because anytime you see a depiction of the G fund, you see a straight line.
Right.
Normally, right? That's not a straight line.
No.
Yeah.
Now, if you did the percentage move of it, it's pretty
more of a straight line.
Well, like if you said 2023 to 2024, it looks like it goes up quite a bit. But if you did, what's the percentage move of 18 minus 17.25, and you took the percent of that, that would be your annual move, and it's like 3%, which makes sense because
I didn't have it on the chart there. You might want to show that again. Oh. I had us up there. I was paying attention to you.
Yeah. So
not doing the show.
This is a little bit because if you're looking at this, you're like, wow, the G fund really goes up, right? But on a percentage basis, it's not going up very much. I mean, we're going all the way back to 2015.
Yeah.
It doesn't go up very much. It does go up. It never goes down, right? So this flattening was,
it just means the rise was slower.
The rise is slower, right?
Yeah. But I just found it interesting because you're actually looking at a chart of the G fund, and it's not a straight line. And you can see, again, during that time frame there, it rose slower. Never do you see it go down. Right. And it's to let that soak in is important.
Yep.
That the G fund is a very safe place to be, depending on what you're using it for.
Yeah, definitely depending on the circumstances. It would be interesting. I'll play with this in stock charts and see if I can put it on a percent scale and some other things to make it a little bit more valuable. But yeah, I thought that was pretty interesting. So now we have all 5 funds. Now you're not going to find it anywhere else on the internet, the actual TSP numbers. So, all right, that is all I got. Questions?
As usual, if you have questions, you can send them to us in the comments section wherever you found the video. If there's no comment section, shoot us an email, not a T-mail, an email. I'm still getting over a little sinus infection, so I apologize, guys. I tried to mute my mic anytime I was coughing, but if somehow I made it through the mic over Jerry,
he'll get over it.
I apologize, yeah. But if you're wondering who that was hacking in the background, it's this guy. But hopefully by next show, it'll all be good. I hope you guys have had a great weekend and have a great week coming up, and we will see you next time.